Hey guys, welcome back to the channel. Today we're going to be doing a top 3 dividend stocks for Canadians that you should be buying right now, especially with the market downturn. Sadly, we are pretty much right under 5% under where the market high was because the market has been rallying for the past week. But hey, let's hope for another market downturn in the next, hopefully, week or two. So for the first stock, we're going to be starting with Fortis, right? You're looking at one of the top 15 utility companies in North America with a 46 years of dividend growth, right? Which is amazing. That means they're pretty much just 4 years out before reaching their dividend king status, which is amazing, especially for a Canadian company because there's not much out there. A lot of them are US only. The main thing why a lot of people like Fortis as a utility company is because they're into renewable energy. They mostly focus on electric utilities, the the barrier to entry into renewable energy is extremely high. You can't even get somebody with 100 million, $200 million to get it and be able to start a company, right? So you're looking at a company that does not have a lot of risk, I guess, for new competitors. And it's a company that is still growing, right? If you look at the chart over here, it has been consistently growing every single year, and it's given us about 53% on our money in the last 5 years. And you're looking at also at a company here with a dividend yield of 3.45% and a payout ratio of 50%. So any company that whose payout ratio is less than, honestly, I'd say 70%, it is extremely healthy. And a dividend yield of 3.45 and a 50% payout ratio just sounds amazing. Fortis has also been growing their earnings per share, right? It's not exactly a boring company, I would say. Uh, for 2020 for basically next year they're expected to bring in about $32 billion, and for the next 3 years they're expected to bring in about 36 billion. If you look at the earnings per share here, we're gonna go right here. 2017 they made about $1.78 per share, 2018 $2, and 2019 $2.85. They're easily growing their earnings per share every year. It's a company that's growing a lot, and especially with electric electric utility being our future, right? A lot of people are transitioning over to electric cars. They're running their house off Tesla batteries, right? Electric utilities are the future. Maybe not in the short term, but in the very long term, they will be, right? Especially if you're a young investor, it's probably one of the best utility stocks for you to buy for, honestly, I'd say the next 20, 30, 40 years without even any worry. Next, we're going to be looking at a financial stock. We're going to be looking over here at TD Bank, right? The reason why I love TD Bank so much is simply because of their presence into the U.S., right? Especially with the weekend. I wouldn't say very weak, but still very slightly weaker housing market here in Canada. You want whatever financial bank you invest in, you want them to have exposure, outside of Canada, and TD is one of the best one, right? It's been named as one of the most convenient banks in the U.S., and a lot of people have been switching over to TD, especially in the U.S., right? And their only, I guess, main competitors in the U.S. is Wells Fargo and Bank of America, and well, Wells Fargo just got caught with fraud, and Bank of America is honestly doing pretty good, but for a Canadian, we want to avoid, right, buying a lot of we don't want to avoid buying U.S. stocks. It's just that it's better, especially if you're buying hold investor, buy and hold dividend investor, to buy Canadian stocks, right? You're looking here at a company whose fair value is about $80. So right now it's about 25 percent undervalued from where its fair value is at, and the company has a dividend yield of 5.25% and a payout ratio of only 45%, which is the main reason why I love this bank so much. The payout ratio is so low to where they have so much room to grow, and honestly, market downturns at 45% payout ratio, it doesn't even matter, right? We saw the CEO come out a few weeks ago and tell us that they're not even worried about their dividend, right? Because the company's been doing so good on their payout ratio, and even in the next 2 years, they're estimated to be around at a 50% payout ratio. Of course, we cannot predict that, but that's what analysts are telling us. And honestly, 50% in the next 2 years, that is extremely good. Uh, even even at the price right now, you're getting it at a 25% discount from its fair value, which is great, right? And even in the last 3 months, you're looking at a stock here that insiders have been buying, right? So we know about three investors who've bought about $4.6 million worth of TD, and a lot of hedge funds are also stacking up on TD. Again, like I said, um, because of their presence in the U.S. and they're able to give a lot of loan. The only issue with a lot of these banks, I guess I would say, is that they do tend to lend a lot of money to oil companies, I am I am a very big fan of oil companies, but a lot of people are more I guess they kind of want to stay away from oil. So when you look at a chart of TD compared to all the other banks when it comes to oil lending, you can see it's not in the highest, right? Scotiabank and RBC have the highest lending rate, and then TD is about in the middle, right? So no, you're not completely safe by not investing in oil, but TD still has loans that are, in the oil sector, which is not a bad thing, right? A lot of people might say it's a bad thing, some might, some don't. It's really how you kind of view the future of the world. I still believe that oil is going to be here for a very long time to come. I don't think we live in a society who's ready to fully be electric anytime soon, honestly, especially with a lot of the machinery in third world countries. They can't really afford electric stuff. They stuff everyone in on petrol. So even though developed countries might switch to electric, I don't think a lot of third world countries will. So simply because of their presence into the U.S. and their extremely low payout ratios, why I would recommend TD Bank over any other Canadian bank. Now, honestly, you can invest in any of the big six, and you'll be doing more than fine. But TD for me is the best choice, and it is one of the biggest positions um, in my portfolio. Third and last stock we're going to be talking about is Enbridge for all you oil lovers. So Enbridge does not actually produce any oil. They're a pipeline company, right? So they only transport it from point A to point B, or or they'll share it between other companies, but they do not produce any oil themselves, right? And then with the market downturn, you're looking at a company whose dividend yield is around 8.10%, which is really high. And they're not really expected to they're not expected to stop it. They might cut it. I do expect maybe a very small cut, but I do not expect Enbridge to stop paying their dividend, right? Especially being the third largest company in Canada, I'm honestly not worried about Enbridge, right? They're easily going to get bailed out if anything does happen. The very cool thing about Enbridge is that they have a lot of contracts that are 20 to 25 years long, right? So they lock these other companies with them at extremely low rates, but these companies are locked in with them for the next 20 to 25 years. So you're looking at a company who has very predictable cash flow, and they recently just they didn't acquire, they made a deal with Spectra and they acquired their business, and now one third of Enbridge's business is coming from natural gas. And you want a oil company to be doing that, right? You don't want an oil company to simply stay in oil, because in the long term, especially with the decline in oil use in first world countries, well, it's going to cause a lot of problem, especially when it comes to earnings per share. But since they are branching out and they do want to slowly start going greener, it's a great company to invest in for the next 20, 30 years. Of course, we can't predict anything, but for now, where it is at now, it is great. Fair value on the company is around $61, so you're looking at about a 34-35% discount from fair value, and it's been paying a dividend for the past 65 years, and it has, I believe 24 years of growth, so it's almost a dividend aristocrat. So there's nothing to honestly worry about, and they're so large that they own almost 70% of Canada's pipeline here. So honestly, you're looking at a very well-rounded company, right? You shouldn't expect the company, honestly, I wouldn't expect the company to double in price in the next 5 to 6 years, but I do expect them to keep that very high yield and stay very stable and stay very present, and have a very big presence here in Canada. So guys, thank you guys very much for watching, and that's it. See you guys next time.